Let's talk to Paul Donovan, Deputy Head of Global Economics and Managing Director at UBS. Well, I think there's a lot of people out there that would not disagree with you. Are you at all encouraged by what's been going on over the last couple of days, what we've heard so far out of the summit?
Well, I mean, there are some things which are moderately positive. I mean, there's talk about treaty change. Now, ultimately, this whole thing doesn't work. How do you make it better? Well, you're going to have to change the treaty. We're going to have to move towards some kind of fiscal confederation over time. So, to that extent, fine. Okay, that's a good signal. On the other hand, what we're hearing being talked about with the bank recapitalisation plan suggests that we're going to get a negative growth shock from that. You're giving the banks 9 months to recapitalise. The chances are they're going to reduce assets. That means lending less into the economy. Not good for economic growth. There's no attempt to tackle the growth problem of Europe, which is a key part of this issue.
It is scary when you look at what the banks are saying, how much they'd like to offload. They don't want to sell shares because they'd have to do it at these rock bottom prices, even if there was private demand. But just tell us more about how exactly that's going to hit the real economy. They're going to pull back on lending to businesses. How's that going to work?
Well, I mean, that's the risk, that we start to see an attempt to scale back bank lending. Because, I mean, even if you're not going to be absolutely cutting loans, you're hardly going to rush out and be trying to lend more money if at the same time you're trying to pull back on other parts of your balance sheet. Now, for the periphery, this probably doesn't matter. I mean, the periphery is pretty much dead in the water. For the core countries, this isn't actually a huge issue either. For core Eurozone, we haven't really seen bank lending be that important. But for France and for Italy, bank lending has been quite an important prop for growth over the course of the last 12, 18 months. Take away that prop, and about a third of the Eurozone suddenly starts to weaken significantly.
What about the other aspects of the plan that are being looked at and decided upon? The EFSF, for example. What do you make of the? Is it a good thing that they've decided not to turn it into a bank and allow it to leverage the ECB's balance sheet?
To be perfectly honest, I never really thought that was practical. I mean, if we look at the European Bank for Reconstruction and Development, it took 2 years to create that thing. I mean, to try and create a bank overnight it's just not a practical solution. And of course, one of the key factors we need now is speed. We can't have something which takes 2 years or even 6 months to implement. What we want is decisive action, which I realise is perhaps a little optimistic when we're talking about Europe, but that's what we need. So I never thought that was particularly practical. What we do need is something which is convincing to the markets, and actually what we've heard so far isn't really that convincing.
So this sovereign insurance mechanism that they might apply with the EFSF, that's not going to be convincing, you're saying?
Well, it might help, but frankly, I mean, if we're talking about prospects of default or risks of default and trying to mitigate risks of default, is a 10% or 20% insurance policy, which is what's being discussed, actually going to suddenly change investors' mind? I mean, in Greece, we're talking about 60–70%
right.
Losses, or in terms of net present value. So, 20%, well, I mean, it's something. But in the grand scheme of things...
And quickly, what about IMF involvement? Because this is something we're going to hear more about on Wednesday.
I think the IMF involvement, yeah, possibly, but it's tricky to have it on a large scale. The Americans aren't happy, the Asians aren't happy. This is not what the IMF is for. The IMF is there as an international organisation for capital account issues, not a domestic currency problem, which is what the Euro empire has got.
Let's bring in our guests. We've got Ralph Silva of Silva Research Network and Paul Donovan, Deputy Head of Global Economics at UBS. Welcome, guys. So interesting here to compare Sarkozy's loss here, as you might put it, in Brussels, to the French losing the rugby. But this is serious. I mean, the reason that he wanted to use the ECB was because France is in danger here of losing its AAA credit rating. And some people are now saying that that's something that may be Europe's biggest worry at the moment. Do you guys agree, Paul?
Well, I mean, I think in time France will probably lose its AAA rating. The fiscal position has been deteriorating steadily since before this crisis. And although maybe not immediately, the credit rating agencies are pretty random these days, so it could go. What does that mean? Well, it means, of course, that the FSF AAA credit rating is vulnerable. How much does that matter nowadays? Well, AA is the new AAA. So yes, exactly. I'm not sure that this is absolutely critical. What I think would be significant is if France is downgraded at some point. That probably changes the political dynamic. It would be quite a big political deal for France to lose its AAA rating, and it might motivate a further spur to integration within the euro area.
We might not be calling them Mercosi anymore. Have you heard this one? Merkel and Sarkozy.
I have heard that.
What do you think, Ralph?
I think I completely agree. I think that Moody's and S&P, their days are done. I don't think they have as much of effect in the markets as they ever had. And in fact, I think they're about 6 to 8 weeks behind the curve anyway. So I think a lot of that's already been priced into the marketplace. So I don't think it's such a big deal. But from a political perspective, it is a big deal. France certainly doesn't want to go into that position. But what's ironic about France is that actually their banks are doing well. In comparison to the rest of the banking industry throughout Europe, their banks are actually fairly well capitalized, and their positions in Greece are not going to kill them. Even if they were to write down the Greek positions 100%, the French banks, and only the French banks, would still survive.
But weren't the French banks the biggest concerns? Don't they have the biggest exposure to Greece? So you're saying this is not such an issue?
They have the biggest exposure, but they're also the biggest banks to have an exposure. So they can actually absorb it. So as a percentage of their overall assets, it was actually smaller than a lot of other banks in Europe. So in other words, they were well diversified, and that's very positive for the French banks.
So does that mean that a 50% haircut and this is what they're arguing over, they're arguing at the moment over how much of a haircut will be taken in terms of Greek debt. Can the banks handle that?
Can all the banks handle that? Absolutely not. Can the French banks handle it? Yes, but it's going to kill especially the Spanish market. I would estimate that a 50% haircut would take at least half the banks in Spain completely out of play. Right? But of course, there's over 1,000 banks in Spain, so the argument can be maybe that's okay.
To be reduced,
Yeah.
right?
Which politician wants to be the first one to say, I'm going to let my banks die? There's no courage there for that.
Paul, do you agree with Ralph and Ralph's theory that they're behind doors right now talking about letting some banks fold?
I think there's certainly discussions going on there, and they're open to quite a large number of options. If we're talking about 50% haircut, 70% reduction in net present value of Greek debt, that scale of thing, then realistically this has to be part of the discussion. How do you shut down parts of your banking system in an orderly fashion? And after all, I mean, we look at the United States, another 4 banks close this weekend. 4 banks close every Friday in the United States. It's pretty much automatic. Pavlovian reaction, the closing bell rings and 4 banks go bankrupt. So I don't see that there's necessarily a problem with this as long as it's done in an orderly and coordinated fashion, and preferably done at a euro level. This is one of the critical things. When this whole debacle was set up in the 1990s, one of the main criticisms of economists, there is no credible lender of last resort in the Eurozone. We need to be moving towards that with this crisis.
Yeah, good point. We don't have the whole thing that we missed about this entire crisis is we didn't develop a plan B. Maybe it's a postal bank service. I don't know what the answer is, but we never actually went into a point where we're going to say if the banks aren't doing something, we have an alternative. We don't have an alternative in Europe, and that's our biggest problem. Is we have to save at least a large portion of the banks simply because we don't have an alternative. But I honestly believe that if we do let 1 or 2 banks go belly up, as it were, we're going to have enormous volatility for a period of a week, maybe 2 weeks in the market, and then everything will settle down. This is like taking a plaster off. We can take it off slowly or we can take it off quickly. In my opinion, let's let some of the banks die gracefully, I agree gracefully, not let one customer lose any money, but let's do it quickly, let's go through the volatility, and then we'll move on. And I think somebody has to have the courage to say, let's do that.
All right, guys, we've got to leave it there. Ralph, Silva, and Paul Donovan, thanks very much for being with us.